Good afternoon. Jason Pries here, CEO of Pries Capital. Welcome to our monthly market trading report. Today, I'm going to move fast and deliver a clear, actionable view of what just happened in markets and what it means for positioning going forward. We'll start with the big picture, index and style leadership, then drill into sector dynamics, the macro engine room, inflation, employment, housing, and services, before we lay out what the Treasury curve and bond funds are signaling for risk, duration, and hedging. I'll close with the Pries perspective, a concise roadmap for advisors and allocators balancing return targets with today's evolving policy backdrop. Our North Star remains the same. Interpret the data, not just recite it, and translate that into portfolio construction you can defend in front of clients. Let's get to work. This deck was released October 2, 2025, and is designed for advisor-ready communication, client-safe charts and figures with emphasis on what changed and what to do about it. Use these visuals in your own briefings. They're built for clarity and repetition. Today's lens: the Fed just delivered its first rate cut of the year, gold broke to new all-time highs, and risk rallied with technology leadership. I'll connect those dots: policy shift, curve behavior, equity-style performance, bond fund response, so you can calibrate exposure across equities, duration, and diversifiers with confidence. At the top level, September was a risk-on with policy support month. Equities advanced broadly. Emerging markets led on the month, and the trailing 12-month window shows double-digit gains across the major indices with the Nasdaq out front. The takeaway for allocators is twofold. First, beta still pays when policy is easing, especially where growth visibility and balance sheets are strong. Second, recent breadth improvement argues against an overly narrow barbell. We want to maintain core equity exposure while being intentional about where the incremental risk dollar goes, tilting toward quality growth and select cyclicals that benefit from easier financial conditions, while keeping a sleeve in diversifiers that protect if this rally exceeds fundamentals. In other words, stay invested, but keep the shock absorbers on. September delivered the year's first Fed rate cut. Markets anticipated it, so the reaction was measured rather than euphoric. Classic buy the rumor, square the risk after the fact. Under the surface, softer labor prints and moderating inflation metrics lend credibility to a gradual policy normalization path into 2025. For portfolios, the nuance matters. Don't just add risk generically. Rate-sensitive assets, select real estate credit, quality duration, and cash flow compounds stand to benefit as forward curves bend. But avoid the trap of treating one cut like a green light for blind beta. The Fed is easing, not rescuing. This is a carry-friendly regime where cash yields step down, duration regains relevance, and balance sheet quality is repriced upward. We'll lean into that with measured duration adds and selective cyclicals rather than a wholesale shift into low-quality momentum. Equities moved higher across the board, with the S&P 500 printing one of its stronger months of 2025 alongside the Fed's first cut. The message underneath the price action: leadership is still growth-centric, but participation broadened enough to argue this is more than a pure mega-cap story. Practically, that supports a core plus equity stance. Own the durable growers, yes, but complement with cyclical exposures that monetize an easier policy backdrop. For advisors, rebalancing away from cash that no longer pays 5% plus and back toward risk assets should be strategic, not binary. Use incremental adds on weakness and avoid chasing high beta breakouts that ignore margin resilience and free cash flow. The month's tone: supportive, not speculative. On the month, emerging markets led at plus 7.2%. Followed by the Nasdaq at plus 5.7%, S&P 500 plus 3.7%, Russell 1000 plus 3.5%, Russell 2000 plus 3.1%, and the Dow and developed markets near plus 2.0%. On a trailing 12-month basis, all the major U.S. indices are up double digits, with the Nasdaq up roughly 25%. What does that imply? First, global beta is re-engaging as the dollar's impulse cools and policy tilts easier, good for EM. Second, U.S. growth remains the world's quality anchor, so we still favor U.S. large-cap growth as the core carry of the equity book. Implementation: keep the S&P/Nasdaq core intact, selectively add EM beta where currency and policy tailwinds are improving, and treat small-cap adds as a paced rotation, not a sprint. Fundamentals and refinancing calendars still matter. Large-cap growth led again in September, up roughly 5%, with small-cap growth next and all equity styles positive. The structural takeaway remains: in an easing cycle without a growth scare, quality growth compounds, particularly where operating leverage, pricing power, and balance sheet strength are intact. But the relative setup also argues for a smarter core. Avoid overconcentration in a handful of names. Blend large cap growth with mid-cap compounders, Incrementally introduce cyclicals where earnings revision breadth is improving, and resist the urge to buy deep value purely on multiple. Today's cut is favorable for duration-sensitive equities, but the market will keep paying for visibility and cash flow. Own the engines, not just the badges. Sector leadership was clean. Technology led at plus 7.5% in September. Materials lagged. On a TTM basis, 4 sectors are up 20% plus while healthcare is down roughly 8%. The why matters. Tech is the purest expression of easing financial conditions plus secular productivity, AI CapEx cycles, cloud, and semis leverage falling discount rates and firm end demand. Materials lag reflects the still mixed global goods cycle and China-sensitive exposures. Healthcare's drawdown is a reminder that policy and pricing overhangs can cap multiple expansion even with solid fundamentals. Portfolio application. Keep a structural overweight to quality tech and semi-cap equipment, pair with cash flow consumer discretionary, and selectively add financials where NIM pressure eases and fee income grows. Stay underweight areas where pricing power is constrained by policy. At the single name level, leadership skewed toward information technology and select cyclicals. Names like AppLovin, Western Digital, Seagate, Micron, Intel, Lam Research, and Robinhood posted outsized monthly gains, with communication services, Warner Bros. Discovery, and Paramount also printing strong moves. The pattern reinforces our theme. Easing policy plus secular compute demand channels alpha into semis, software monetization models, and platforms with operating leverage to volumes. For PMs, translate this into process. Don't chase the far-right tail, screen for balance sheet strength, CapEx discipline, and revisions momentum. Allocate to semiconductor leaders benefiting from memory recovery and equipment replacement cycles, and keep a catalyst calendar. Results dispersion will be high, and we want to fund buys out of weaker, thesis-less rallies. On the downside, weakness was concentrated in select healthcare, IT services, and consumer names. Examples include Humana, Deckers, Constellation Brands, CarMax, Dollar Tree, and Kenvue. The dispersion cautions against beta solves everything. Fundamental idiosyncrasies, pricing, cost inflation, utilization, and policy sensitivities still dictate outcomes. For risk management, use this list to fund upgrades, trim where thesis drift or valuation stretch exists, and redeploy into quality growth or cyclicals with cleaner catalysts. In client terms, we're not buying the market, we're continually optimizing the mix of durable cash flows and credible growth against a policy backdrop that is supportive but selective. Let's pivot to the macro engine that powers multiples and earnings. We'll connect 4 pillars: employment, inflation versus the policy rate, housing and mortgages, and services activity, then overlay gold as the risk hedge tell. The quick spoiler: labor is cooling without cracking, inflation has moderated but isn't done, housing is stabilizing as mortgage rates creep down, services momentum is re-accelerating, and gold's breakout is the market's way of paying for macro insurance into 2025. We build portfolios around those facts, keep quality risk on, add measured duration, and maintain convexity via diversifiers. The unemployment rate ticked up to roughly 4.3%, and non-farm payrolls missed expectations, evidence of a cooling, not collapsing, labor market. This is the soft landing sweet spot the Fed wants. Wage price pressure eases without forcing an earnings recession. The implication for risk: equities can rally on multiple stability, but earnings breadth matters more than ever. We want companies that can grow units and defend margins as labor tightness fades. For credit, softening labor supports the case for spreads to grind rather than gap. That's constructive for carry, particularly in short to intermediate corporates, though we still avoid the weakest coupons that depend on capital market generosity. Headline inflation rose to roughly 2.92% in August. Core remains sticky but directional. PCE printed roughly 0.4% month-over-month with personal spending roughly 0.62%. Consumption is slowing, not stalling. Against this, the Fed cut its target range by 25 basis points and signaled additional, data-dependent easing into year-end, with the next decision due October 29. Portfolio math: as real rates drift lower from restrictive levels, duration regains its hedge value, and quality growth's present value improves. But we shouldn't position for cut to zero. We're navigating toward neutral, not stimulus. That means avoid overduration at the long end. We prefer a belly tilt that balances roll down and convexity without overexposing to term risk. New single-family home sales spiked by roughly 20% month-over-month, while mortgage rates eased, 15-year near 5.74% as of September 25, and the 30-year closing the month around 6.30%. Translation: affordability is still tight, but directional improvement is in place. For portfolios, That argues for selective housing-linked cyclicals, building products and certain distributors, while staying careful with levered real estate investment trusts where capital costs remain elevated. In credit, we prefer higher quality CMBS RESI exposed credits with visible cash flows over speculative projects. The opportunity here is surgical, not thematic. Services PMI surged to 52.0 in August, its largest two-month gain since December 2024, indicating a re-acceleration in the economy's dominant engine. This supports spreads, supports earnings breadth, and supports the Fed's confidence to normalize without panic. For sector tilts, that's a green light for selective services, heavy exposures, payments, platforms, travel-adjacent services, so long as pricing power and unit volumes remain credible. The equity credit handshake says, own cash flow quality, fade the weakest balance sheets, and let the policy tailwind work for you rather than trying to outrun it. Gold rallied roughly 12% in September to new all-time highs. GLD finished near $355.42. Why does that matter in a risk-on month? Because the market is willing to pay for macro hedges even as equities climb, policy easing, lingering inflation uncertainty, and geopolitics all argue for convexity. Our stance: maintain a modest gold allocation, or gold-sensitive equities, as a portfolio shock absorber that doesn't require a hard landing to work. It's not a bet against risk, it's an inexpensive hedge when policy transitions can still surprise. Let's translate the policy shift into the curve and bond funds. Think of three levers: yields, curve, and spreads. In September, Treasury yields declined across the ends of the curve as markets priced easier conditions. That sets a supportive backdrop for quality duration and carry, especially in the belly, while keeping us vigilant on the long end where term premium can snap back. For credit, the message is constructive but selective. Carry works, but underwriting still matters. We'll combine intermediate IG sleeves with a tactical high sleeve and a bit of long duration as a risk-off hedge, not as a core bet. Here's the curve detail. Approximate end September yields: 1 month roughly 4.2%, 3 month roughly 4.02%, 1 year roughly 3.68%, 2 year roughly 3.60%, 10 year roughly 4.16%, and 30 year roughly 4.73%. Month-over-month shifts showed declines at the front and long ends, with small upward tweaks in the belly. The portfolio takeaway: bias duration toward the 3-7-year sector to harvest roll down and convexity while using 10/30s sparingly as a hedge. On the short end, as cash yields step down, redeploy into laddered EE to keep income durable. Avoid over-concentrating in ultra-longs, use them as risk insurance, not income engines. Bond funds validated the curve message. Over the TTM, high yield is up roughly 7.1%. While long-duration treasuries, TLT, are down 4.9%. In September, TLT bounced roughly plus 3.6% as yields eased. Translation: carry continues to work, but your duration bet determines your volatility path. We pair an intermediate IGCHOR with a smaller high sleeve for income, and we keep a tactical long-duration allocation for equity hedging, not performance chasing. If the easing path continues and growth remains resilient, the belly does the heavy lifting. If growth disappoints, that long-duration hedge earns its keep. That is a robust, multi-scenario bond allocation. To wrap, September confirmed the transition toward easier policy, a still resilient services economy, cooling labor without collapse, and risk assets that continue to respond, led by technology and semiconductors, while gold breaks to new highs as a low-cost volatility hedge. That backdrop informs our positioning as we head into year-end. We keep a quality growth core at the heart of the equity book, and broaden selectively beyond the mega-cap cluster where earnings visibility, balance sheet strength, and pricing power remain credible. In fixed income, we add duration in the belly of the curve to harvest roll-down and convexity, maintain an investment-grade core for dependable carry, and hold long duration as a purposeful hedge rather than a performance bet. For diversifiers, we retain a measured allocation to gold, not as a call on crisis, but as convexity that works across multiple macro paths. And on risk management, we trim idiosyncratic laggards to fund upgrades, stay selective in lower quality credit, and insist on catalysts and cash flow discipline before we underwrite anything new. As always, use this deck with clients. It's built to help you communicate clearly, defend decisions, and execute with confidence. Thank you for joining us for the October 2025 Market Trading Report, live from our office tower in Myrtle Beach, South Carolina. As we wind down 2025, having navigated the challenges of 2024, which ultimately turned more favorable for investors across both stocks and bonds, we anticipate a more volatile, opportunity-rich finish to the year. At Pries Capital, we're prepared and vigilant for a dynamic fourth quarter. balancing offense and defense so your portfolios can compound through different weather. On behalf of our entire team, I wish you health, happiness, and continued success through the remainder of 2025. Thank you for your continued support of Pries Capital Investment Research. I'm Jason Pries. This is the Pries Perspective.